So today's topic is something that in our current real estate market and environment, I don't think it gets enough airtime or attention. And so I wanted to bring it up, and maybe you're thinking about a move today and this will be relevant. But maybe you're thinking about a move in 2, 3, 5 years. And in my opinion, this information will still be relevant. So the topic is assuming an existing mortgage. Let's talk about what it is and why it might matter to you. Okay, so the what it is. I've got a bunch of gibberish behind me on the whiteboard here that we'll talk about in a second. But in its most simple form, think about it this way. Someone who owns a home is selling their home, and they, the owner, have a mortgage on their house currently. And so assuming it means that you, the buyer, are going to take over their payments, or basically step into their shoes to begin making the payments on what was their mortgage and will now be your mortgage. Okay, let's talk about the nuts and bolts of this and to the gibberish on the board here. So I've got a hypothetical played out on our whiteboard. And the scenario is this. Let's say a homeowner purchased a property in 2016 for $400,000. They're going along, everything's great. In 2021, they decide to do a cash out refinance. They paid $400,000 for the house. Let's say their loan balance is, mid threes. And they say, we need $100,000 to go pay off car loans, student loan debt, credit card, whatever. So they do that in the middle or summer of 2021, and their new 30-year mortgage is at an interest rate of 2.75%, and their payment for principal and interest is now $1,837. They begin making that payment, plus some taxes and insurance, but that's not the point. 2 years go by, and here we are coming into the summer of 2023, and they get a job offer. One of them gets a job offer, family's growing, family's shrinking, whatever the case may be. They've got to move, and they've got to move out of town, and they've got to do it right now. And so they decide to sell the house, and they put the house on the market. What they once paid $400,000 for is now worth $650,000. So good for them. They invested in real estate, and it will have paid off handsomely by the time they sell the house. But you, the buyer, don't really care about that. What you care about is that you love the house, you want to move into it, you've talked to your lender, and you're even willing to pay the $650,000 for it. You realize, though, that you're going to do a conventional loan, and if you're putting 20% down, that's a loan amount of $520,000, and you're going to be paying 6.5% interest, let's say. Again, just a hypothetical. But the monthly principal and interest payment on that is about $3,286, where $3,286 compared to our current owner's $1,837 monthly principal and interest payment is very different. So you start to think, well, how could I get an $1,800 monthly principal and interest payment? Assume the mortgage. That's the answer. And so what's the catch, or why wouldn't you do this? So you're putting 20% down because maybe that's all the cash you have. Well, the challenge is, if you're going to assume the mortgage, you have to assume it in its current form. So that means if you're going to pay $650,000 for the property, and the current balance on the mortgage that they just refinanced at $450,000 a couple years ago is now $430,000, you're going to have to come up with about $220,000 in cash versus the $130,000 in cash that you would need to come up with if you were going the conventional route with a traditional mortgage company or lender. So you may have to come up with some more cash. But there are ways to address that and to still carry forward the deal without having to come up with all of that out of your back pocket necessarily. The point is, this is just food for thought. If you're thinking about buying, if you know anybody that's thinking about buying, or maybe in the future if you're thinking about buying, you might want to have this little idea of assuming the mortgage rattling around in the back of your head so that you bring it up to the seller whose home you want to purchase, because it may be that it could save you a tremendous amount of money in interest for your next home purchase. So those are my thoughts for the day. If you've got any questions, feel free to reach out, 904-405-1995, or you can shoot me an email, jeff@era.com. Hope you're doing well, and we'll catch up soon. Take care.